pool, it's hard to create new assets. You really can't go out and raise plentiful capital. And we saw in '07 that the market was starting to come apart and unglued, which it obviously did. And I mean, the whole capital structure collapsed, and one of our partners was banked. So the next thing that happened was we found that the unthinkable occurred, which is that our partner ceased to exist, which was UBS, and they just stopped existing. And that was not something we ever.
Just nervous here for a moment. You say one of the banks I was working for, so that building.
No, it was still REIT. And but they did close all the deals. So we ended up with $1 billion of assets in '07, and we made money on them. It was fine. And then early in 2008, we looked into public. We tried institutional. Now let's look at what else is out there. We looked at the non-traded space, and we were just completely utterly nauseated by the entire concept of how it was running, how it was working, the fee loads. It was really not what we thought was good. But what we did notice immediately was the negative space, which is that you've got a REIT. It's effectively, when you really drill down on it, it is effectively a continuous IPO that goes on for 3 years. So it's no different. It's fully transparent, SEC, boards, FINRA, states, everybody, lots of regulation, very good product, but it had high fees. So we started to strip out fees. We created a promote structure where we didn't get paid unless we returned capital. And lo and behold, none of our competitors wanted to sell the lower fee product because it would drive their products down. And we had to build our own broker-dealer system, which was probably one of the biggest nightmares that you can imagine, because you had to break into basically the insurance channel, which is how it's sold. And it's very granular. It's a lot of work. It's retail's retail. We have, on average, just to give you some statistics, we have 1 million investors in our non-traded REIT platform. That's actual investors. They are average investment is $25,000, but a typical investment could be $100, and some could be $350. It does, but what it did was it became very obvious in '08 we were able to deploy capital. So between '08 and 2013, we bought about $40 billion of real estate. We raised about $17.5 billion of equity in those years. We did it in 9 different REITs, and we were able to create from scratch in a time in the market when cap rates were highly impacted. We were able to be in the market when everybody else had balance sheet issues in the traded side and the institutional side, and we were able to buy a lot of great assets. But in the meantime, what we were able to do is build platforms with very low leverage. So most of our deals, most of our non-traded REITs, whether it be healthcare, New York, the net lease, or our global transaction, have average leverage of about 17%. So, and it's almost all unsecured, so we start life without a need for, that's why we do listings. We've been able to list 6 companies and create 6 publicly traded companies in the last 3 years, actually the last 18 months. We did 1 this week, we'll do 1 next week, and we'll do another 1 before the end of the month. So we'll have 3 more public entities by the end of the month.
So,